When you're trying to reduce your taxes and save for retirement, as a small business owner, making some small changes could be the difference of millions of dollars over the course of your retirement. So in this video, we're going to answer a question from a viewer to lower your taxes, save more for retirement, and get millions more. So here we go with the question. This is coming from Mike. If I pay myself a W-2 and employ my wife as a W-2, would a solo 401k still make more sense? Business makes about $300,000 prior to all taxes and expenses, around $100K after, thanks. So this would apply to whether or not you're married filing jointly, have a spouse that works for the business, or if you're a sole proprietor, single, it really doesn't matter. I'm going to show you how you can save more, choose the right plan, and get millions more in retirement. So let's tackle the first part of this question, and that is choosing the right plan. Now, this question came from one of my videos on the solo 401k and the SEP, and that is primarily the two plans that you're likely going to look at if you don't have any full-time or eligible employees. So let's start with the SEP, and the math here is pretty simple and straightforward. It's going to be based on either your net profit if you're a sole proprietor, or in this case, it's likely an S corporation because they have W-2s. In either case, again, the math is going to be relatively simple. In the W-2 case, it's going to be 25% of your W-2. That's what you can put into the SEP IRA. So in this case, because it's $50,000 each or $100,000 in net profit, assuming they're splitting it up, 50,000 times 0.25 or 25% is going to be $12,500 for each of these plans. Now that is the maximum amount because in a SEP IRA, you can only make employer contributions. There's no employee deferrals, unlike the solo 401k. And let me go ahead and bring up on the screen the solo 401k contribution limits so we can go through those together. So for 2023, the maximum employee deferral is going to be $22,500. The total amount is going to be $66,000. And if you're 50 or older, you can do what's called a catch-up contribution, and that could be up to $7,500, bringing the total then to $73,500. But for this walkthrough, we're just going to stick with the $66,000 and assume that they're under the age of 50. Now that we have the SEP IRA and the solo 401k contribution limits, let's run through some of that math before I show you how to save a ridiculous amount in taxes and turn that into over $4 million in retirement. So let's start with that SEP IRA. So with that SEP, we now know that we can do up to 25%. So our $50,000 salaries, that would be $12,500. And we're each getting a salary in this case. So that's going to be multiplied by 2. So it's going to be up to $25,000 as a profit sharing contribution. And that is the maximum amount that you'd be able to get into the SEP IRA with those incomes. So it's only $25,000. Now on the solo 401k side, we could do quite a bit more. So the same $50,000, we could still do this as a profit sharing contribution. So it would be $12,500. And then in addition to that, we can do the $22,500 as an employee deferral. So if we add these two numbers up, that's going to be $35,000. The reason I'm adding them up is because the maximum we can put into the solo 401k is $66,000, but there's also another limit that you need to be aware of, and that is 100% of your compensation. So in this case, it's going to be $50,000. So that is going to be our cap for each participant in this plan. So for both for yourself and your spouse. So that means we can do an additional $15,000. Now this additional $15,000 would go into the solo 401k as a non-deductible contribution, which you can then convert over to the Roth side, also known as the Mega Backdoor Roth strategy. So that is the additional $15,000, bringing that total to $50,000. And if we did that for each participant, that would be the full amount of the $100,000 that you can get into the solo 401ks for both you and your spouse. So it'd be $50,000 for yourself and then $50,000 for your spouse in this example. But is that the best option for you? Now, before we get into how you can reduce your taxes, I do also want to point out Social Security, because that is going to be affected by how you're actually paying yourself. So going back to the very beginning, if you're paying yourself $100,000 and then thinking of hiring your spouse and then kind of splitting it up so you can then maximize the amount that you can put into that solo 401k, because if we roll back for just this half a second and take a look at this, if this was just one participant at $100,000, the maximum profit sharing would be $25,000. And then above and beyond that, we can do the $22,500, and then we can do the additional all the way up to $66,000, but we can't get more than that in there. We can't get that full $100,000. It's capped at $66,000. So by splitting it up, we can get the full $100,000 in there. But now we're taking a look at Social Security and how that's going to actually change depending on how you pay yourself. So here's what I mean by that. Let me pull it up on the screen. So I already ran all of these numbers to show you. And what we're taking a look at here is if we pay ourselves $50,000 each, so each spouse is getting $50,000. The projections on Social Security, if we took it at age 67, again, we're starting this plan at age 30 or 31 years old, right around there. If we run those numbers out, Social Security is going to, an estimated amount is going to be $19,207. That would be for each spouse. That means the total amount in Social Security would be $38,414. And then that's going to increase with inflation. If we add all those numbers up, $4.7 million. However, that $100,000 single earner would get $29,238, and the spouse usually gets up to half. So that means $14,624. So if we add those numbers up, that's $43,862. So wait a second. Now, if we only have one spouse earning 100 versus each earning 50, we will get more in Social Security. And look at this. If we add it all up, and then figure out how much more, that's over $675,000 more in Social Security over the course of your retirement. But maybe Social Security won't be there. So why even bother looking at it? Okay, that's fine. Let's go ahead and see what we have before we see a third option that could be even better. So right now we know that the solo 401k in this scenario is better whether or not we're paying ourselves $50,000 or $100,000. It really doesn't matter. The solo 401k is going to offer you more flexibility than the SEP IRA, and you're going to be able to get more money into the solo 401k than you could with that SEP IRA. So we already know that. And when we're looking at the Social Security, it might look like, okay, maybe I shouldn't be paying my spouse or hiring my spouse and only pay myself. But there is a third option here that might be more attractive, not in all situations, but it might make more sense to actually do this. And this is where that W-2 with the S corporation comes in. What if you only have one spouse who pays themselves a reasonable salary at $50,000 and then takes that other $50,000 as a distribution, because that distribution avoids the self-employment tax, whereas the contributions to a retirement plan do not. So let's go ahead and take a look at that. So if we look at this right here, we have the distribution of $50,000, which now is avoiding that 7.65% for both the employer and the employee, which equals 15.3%. So 15.3% times $50,000, that's where we're getting this $7,650. Well, what if we invested that money that we no longer have to pay to the government, right? So we're just going to go ahead each and every single year, same thing as before. We're increasing our income each and every single year with inflation, and we're going to go ahead and invest it at a 10% rate of return. Now, if we do this, that is going to equal a total of over $3 million. $3 million more by taking a $50,000 salary and a $50,000 distribution. Now, because we're taking that $50,000 distribution and salary, that means we're going to be paying less into Social Security. So our Social Security is now at $19,207. And for that non-W-2 spouse now, it's going to be about half that. And that means we're going to be taking less in Social Security at $28,811 versus the total of $38,414 if we're each at $50,000 or the $100,000 at $43,862. So this is the least amount in Social Security, but we're also taking the difference in that Social Security payment or the FICA payment. And what we're doing is investing those dollars. So now if we look at these totals, we could see that we're taking less of an income from Social Security than we did in the other two scenarios. But let's go ahead and turn this $3 million into an income stream. If we do that, we could take that money and take it as a distribution. So let me show you what this looks like on our calculator. So if we have 29 years of retirement from 67 till age 95, just an assumption there, and we take it at 4%, and we take that $3,057,000, and we have nothing left at the end of the day, we can actually maximize it to just over $180,000. So let's go ahead and take $180,000 and put it in here each and every single year. And we're going to go ahead and pull that number down for every year for 29 years. We'll say that equals, see what that looks like. And that's going to be $5.2 million. If we add these two numbers up, we're going to have over $8.7 million. And that is just making a change to the Social Security side to get us that additional $4,029,606. We could still take that other $50,000 at W-2 income and put it into the solo 401k. And we can still take that other $50,000 as a distribution and invest it for retirement just in a non-qualified account or a non-retirement investment account. And if you hold those investments for the long haul, you could get long-term favorable capital gains rates. Now, the name of the game is this: don't pay yourself more than a reasonable compensation and take the rest as a distribution. That is what you want to do. But if you're taking a reasonable compensation, getting the maximum amount into that solo 401k is probably going to be a better bet than the SEP IRA in most situations. Of course, if you don't qualify for the solo 401k by having full-time employees or eligible employees, then you'll probably need to look at the SEP IRA or another plan. But in this situation, the solo 401k is the winner. And if you use those distributions to your advantage, you can get a ton more in retirement. So hopefully this has helped. If you have any questions on this, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.